Hi everyone, Mina here from Insider Monkey. In this video, I'm going to talk about the 7 stocks that renowned value investor and hedge fund manager Bill Miller thinks are almost certainly to underperform the market. You might want to pay attention to what Miller says. His hedge fund returned 120% in 2019. Miller came to fame back when he was at Legg Mason. That's where he beat the S&P 500 index for 15 straight years. Right now, Miller is actually very bullish. He says this whole COVID-19 pandemic is one of the top 5 stock buying opportunities in his lifetime. We recently published an interview of him on our website, and you can find the link to that interview right below this video. In his 2020 first quarter investor letter, Bill Miller said something controversial. He said that he hears financial commentators on TV advising investors to use the decline to upgrade their portfolios and to buy quality names on sale, but to avoid or reduce exposure to names that are riskier. But Miller disagrees. He said that a portfolio comprised of all quality names that have been among the best performers in this dramatic decline, would almost certainly underperform the market as the economy and the market recover. Miller continued and said that in big market declines, the prices of stocks fall more rapidly than long-term business values do. He said that they try to use the opportunities to upgrade their portfolios as well, by replacing names that have held up reasonably well with those whose price declines now offer much greater long-term upside when the economy comes back. That's actually one of the most brilliant comments we've heard during this crisis. In that same letter, Miller mentioned 7 quality stocks that performed better than the market during the market decline, but which he expects to underperform as the market recovers over the next 12 months. That first stock is Alphabet. Shares lost less than 5% this year, whereas the S&P 500 lost close to 12% and Russell 2000 lost nearly 26%. By the way, Insider Monkey tracks stocks from nearly 850 hedge funds, including Miller's, and Alphabet is the 5th most popular stock among hedge funds right now. Second is Disney. Disney shares actually lost 30% this year. Miller might have included this stock because its Disney Plus streaming service added 50 million subscribers recently. Keep an eye on Disney. If the stock declines 20% from these levels, it can be a great long-term buy. Third is Nike. Nike shares lost around 12% this year. Miller doesn't like Nike because there are other stocks with at least 50% upside potential. Speaking of which, Insider Monkey just recommended a stock with 100% upside potential over the next 2 years. Miller must be investing in similar stocks. Fourth is Amazon. Shares gained more than 30% this year. By the way, Amazon is the #1 most popular stock among hedge funds right now. Miller is probably selling his Amazon shares and buying other stocks with more upside potential. Fifth is Facebook. Shares lost only about 7% this year. Facebook is the 2nd most popular stock among hedge funds. There are other stocks in the market with higher upside potential than Facebook. Sixth is Procter & Gamble. Shares lost less than 4% this year. And 7th is Clorox. The cleaning products company rallied more than 25% this year. Miller thinks it's time to sell Clorox and buy other stocks that will deliver bigger returns as stock prices recover. Don't forget to subscribe to our channel. We'll be sharing hedge fund interviews and stock picks from investor letters in the coming days. Insider Monkey levels the playing field for small investors.